Have you ever been in a conversation where someone starts talking about a bull market or their portfolio and it feels like they're speaking a totally different language? Yeah, we've all been there. It can feel super intimidating, but you know what? It doesn't have to be. In the next few minutes, we're going to give you the keys to unlock that language. So let's dive right in. Does hearing words like dividends, equity, and volatility just make your head spin a little? It's a really common feeling, but just think of this as your personal decoder ring for the entire world of investing. We're going to break it all down term by term and make it simple. Our goal here is really simple. Let's turn any confusion you might have into actual confidence. Because understanding these terms, it isn't just about sounding smart at a party, it's the very first step to making smarter decisions with your own money. So right here, right now, this is where your journey begins.
Okay, so first things first. Before we can even begin to talk about trading or portfolios, we have to get a handle on the most fundamental piece of the puzzle. What is a stock anyway?
A stock is not just some random number blinking on a screen. It's a real, actual piece of a business. Seriously, when you buy just one share of Apple, you officially become a part owner of the company that makes your iPhone. It's really that simple. Now, you're going to hear the word equity thrown around a lot with stock. Don't let it trip you up. Equity is just the fancy financial term for that ownership. It's your slice of the pie. It represents your claim on everything the company owns and everything it earns. Okay, so you know what a stock is. You get it, but where do you actually go to buy one? It's not like you can walk into a Starbucks and ask for a share with your latte. And that brings us to the marketplace itself. Probably the best way to picture a stock exchange is to think of it just like Amazon. Except instead of buying books or gadgets, you're buying tiny pieces of companies. Big exchanges like the NYSE or the NASDAQ, they're just giant online marketplaces designed to do exactly that. So how do you get access to that big marketplace? Well, you go through a broker. Now, back in the day, this was a person you'd literally call on the phone. But today, it's almost always an app or a website. Think Fidelity or Schwab or even Robinhood. They are your personal gateway to the exchange. Okay, with thousands and thousands of companies out there, how do you find the one you want? You use its ticker symbol. A ticker is basically just a short, unique nickname for a company on the market. Apple is AAPL. Tesla is TSLA. It's the little code you'll type into your broker's app to find and trade that stock. All right, you know what a stock is, you know where to find it using its ticker, and you've got a broker ready to go. So how do you actually do it? Let's talk about placing your very first order. When you go to buy, you have a really important choice to make. A market order is all about speed. You're basically saying, get me that stock right now, I don't care what the exact price is. A limit order, on the other hand, is about control. With that, you're saying, I only want to buy the stock if the price hits, say, $100 a share. One gets you in the game fast, the other makes sure you get the price you want. Now this is one of the most important tools for managing risk. A stop loss is like your automated safety net. You decide ahead of time, okay, this is the most I'm willing to lose on this investment. If the stock price ever drops to that point, your broker automatically sells it for you. It's designed to stop a small loss from becoming a really big one. Awesome, you've made a trade. But here's the thing, investing isn't just about one stock. It's about building a whole collection of assets that can work for you over the long run. And this collection, it has a name, your portfolio. So what the heck is a portfolio? Honestly, it's just the word for all of your investments, all bundled together. If you own some Apple stock, maybe an index fund, and a few bonds, all of that together, that's your portfolio. Think of it like your own personal investment menu. And just like a good meal, a smart portfolio usually has some variety. Instead of trying to pick just one winning stock, which is really hard to do, you could buy an ETF. That's kind of like buying a pre-made basket that has hundreds of stocks in it all at once. Or you could add bonds, which are generally safer because you're basically just loaning money for a predictable bit of interest. So why is all that variety so important? It comes down to one key idea, diversification. And it's not as complex as it sounds. It's that classic advice you've heard a million times. Don't put all your eggs in one basket. By spreading your money out, you lower your risk. If one investment goes down, another one might be going up, which helps balance things out. Okay, for our last section, let's zoom out. You're always going to hear people on the news using these specific terms to describe the overall feeling or direction of the entire market.
Let's learn how to read that mood. You will hear these two all the time. A bull market is when everyone's feeling optimistic, the economy's doing well, and prices are generally going up. Just think of a bull thrusting its horns upward. A bear market is the exact opposite. People are pessimistic, and the market has fallen at least 20% from its recent high. Think of a bear swiping its claws downward. So, what happens if the market drops, but it's not quite a full-blown 20% bear market? Well, a fall of 10% from a recent high has its own name. It's called a correction. And while they can feel a little scary, corrections actually happen pretty regularly. They're often seen as a healthy way for the market to cool off a bit. And finally, volatility. This word just describes how wild the ride is. That's it. A stock with high volatility has these huge price swings, way up and way down. A low volatility stock is much more steady and calm. Understanding a stock's volatility really helps you understand its risk.
And that's it. From stocks and brokers to bulls and bears, you've just covered the essential vocabulary of the stock market. You have the map. That secret language, well, it's not so secret anymore, is it?
You now have the foundation to really understand the conversation and, more importantly, to start making more informed decisions for yourself. So the only real question left is this. Now that you have the map, where will your journey begin?